118. General Studies, Mains, paper. Green Link Subsidy Scheme Facilitate Technology. Upgradation of the MSME sector by providing subsidized loans for upgradation of machinery. The policy of setting up industrial estates was initiated in 1955 for the construction of factory premises and to provide basic facilities like power, water, roads, etc. The concept of District Industries Center, C, was introduced to cater to all the requirements of small-scale and village industries under one route. Still, some producers have been reserved to be produced by MSME sector only. Financial measures. Small Industries Development Fund ISIDE, it was set up in 1985 to provide refinance, i.e., finance to the financial institutions in lieu of their lending to SSIs, assistance for development, expansion, modernization, rehabilitation of SSIS. National Equity Fund, NEP, it was set up in 1987 to provide initial capital for setting up of new projects in small-scale sector in the form of equity the shares. Single Window Scheme, SWS, it was introduced in 1988 to provide short-term as well as long-term financial assistance to SSI. IV, Small Industries Development Bank of India, SIDB, was established in October 1989 by amalgamation of Small Industries Development Fund, SIDF, and Natural Equity Fund, NEF. SIDB is the apex financial institution for small enterprises sector. It provides finance to SSI, refinance assistance, and coordinates the activities of other financial institutions for the provision of credit to SSIs. Fiscal measures. Small-scale enterprises having turnover up to *1 crore are fully exempted from the excise duty. Concessional rate of custom duties are levied on import of certain kind of raw materials and components used by SSIS. A recent purchase preference is granted to products manufactured in the small-scale sector in government purchase program. In recent budget, RACs on companies with turnover up to 750 crore has been reduced from 30% to 25%. To provide easy credit to MSME, government in 2018 has launched a 59-minute loan portal to easy access to credit for MSME. Pradhan Mantri Employment Generation Program aims at generating self-employment opportunities through establishment of micro-enterprises in the non-farm sector by helping traditional artisans and unemployed youth. Technical measures. I. Small-Scale Industries Development Organization, SIDO. It was established in 1954. SIDO provides technical, managerial, economy and market assistance to SSE through its network of extension centers and service institutes. Council for Advancement of Rural Technology, CART. It was established in 1982 to provide technical assistance to rural industries. B. Technology Development and Modernization Fund, IMF. It was set up as the technological upgradation and modernization of the export-oriented units. Schemes, programs for small industries. Under this scheme, the selected lead agencies UDIME Mitras are providing guidance and assistance to the potential entrepreneurs registered with them, in preparation of project report, arranging finance, selection of technology, plant and machinery, marketing tie-ups with buyers, as well as obtaining various approvals, clearances and NGC etc. UDIME Mitras are expected to assist the new entrepreneurs in the establishment and successful running of the enterprise for the first 6 months. The scheme is beneficial to all potential first-generation entrepreneurs in all towns as well as rural areas by encouraging establishment of new enterprises and thereby creating new job opportunities locally. A Udayami helpline, a call center for MSMEs with toll-free number 1-800-180-6763 is in operation to provide information, support, guidance and assistance to first-generation entrepreneurs as well as other existing entrepreneurs.
ఎవరంట
Industrial sector. 119.
చూపినా ఆయన
National Manufacturing Competitiveness Program. The National Manufacturing Competitiveness Program, NMCP, for the MSMEs aims at enhancing the competitiveness of enterprise in this sector. Some components of the NMCP, which have been approved and are available for MSMEs are Design Clinic Scheme for Design Expertise to MSMEs Manufacturing Sector, Marketing Assistance and Technology, Upgradation Scheme for MSMEs Technology of Quality Upgradation Support for MSMEs, Promotion of Information and Communication Technology, ICT, in MSME sector, setting up mini tool room and training centers under PPP mode, Marketing Assistance, Support to MSES, Barcode, Building Awareness on Intellectual Property, Rights for MSMEs, Scheme for providing support for entrepreneurial and managerial developments of SMEs through technology incubators. National Manufacturing Policy, 2011. The contribution of the manufacturing sector, just over 16% of India's GDP, is much below its potential and a cause of concern, especially in the context of other Asian countries in similar stages of development. This also has its socio-economic manifestations and prevents India from fully leveraging the opportunities of globalization. With a view to accelerate the growth of the manufacturing sector, the manufacturing policy proposes to create an enabling environment suitable for the sector to flourish in India. The major objectives of the national manufacturing policy are to increase the sectoral share of manufacturing in GDP to at least 25% by the year 2022. Black Circle to increase the rate of job creation, so as to create 100 million additional jobs by the year 2022. To enhance global competitiveness, domestic value addition, technological depth and environmental sustainability of growth. To provide a productive environment to persons transitioning from the primary to the secondary and tertiary sectors through the creation of large integrated industrial townships called National Investment in Manufacturing Zones, NIMZS, with state-of-the-art infrastructure, land use on the basis of zoning, clean and energy-efficient technologies. To ensure compliance of labor and environmental laws, while introducing procedural simplifications and rationalization, so that the regulatory burden on industry is reduced. To provide an enabling environment for tapping the potential of the private sector and the entrepreneurial skills of the younger population. Highlights of the National Manufacturing Policy. It will set up National Investment in Manufacturing Zones, NIMZS. The minimum land area of each NIMZs or Greenfield Integrated Industrial Townships with the modern infrastructure is to be 5,000 hectares. The first phase of the NIMZS will be established along the Delhi-Mumbai Industrial Corridor. The industrial townships will be self-governing and autonomous bodies. Single window clearance will be provided to improve the regulatory environment. The central government will create the enabling policy framework, provide incentives for infrastructure development on a private-public partnership basis through appropriate financing instruments, while state governments will identify suitable land and be equity holders in the NIMZS. The focus will also be on green manufacturing. In this regard, a technology acquisition fund will be set up to acquire global technologies and build a parent pool especially for equipment manufacturing that seeks to reduce energy consumption. Black Circle environmental clearances will continue to be given as per existing rules and regulations, but the Environment Ministry has agreed to give priority in processing cases from the manufacturing zones. $120. Mudra Bank, 2015. MODRA stands for Micro Units Development Refinance Agency, MIDRA, launched by government in 2015. IR aims to relance microfinance institutions is engaged in lending to MSMFs involved in manufacturing, trading and ACRVICE activities. It will achieve the objective by loving down policy guidelines for MIS registration of MIS accreditation and cutting of MFIA, promoting technology and running a credit guarantee scheme for providing guarantees to INNs. MUDRA would also adopt a Credo Plus approach and take up interventions for development support across the entire spectrum of beneficiary SENINs. Bank will classify its CHENs and will allow them loans up to a fixed amount. Shishu allowed loans up to 50,000. Kishan allowed INNs up to 5 lakh. Fintarun allowed loans up to 7,101 AKH. Startup India, 2016. Startup India is a flagship initiative of the Government of India, intended to build a strong EQ system for nurturing innovation and startups in the country that will drive sustainable economic growth and generate large-scale employment opportunities, since the launch of the initiative on the 18th of January 2016. Startup India has rolled out several programs with the objective of supporting entrepreneurs and transforming India into a country of job creators instead of job seeker. A startup is an enterprise that is initiated by founders around an idea or a prolearn with it potential for significant business opportunity and impact. The government through this initiative aims to empower startups to grow through innovation and design. The scheme covers from digital technology sector to a wide array of sectors including agriculture, manufacturing, social sector, healthcare, education, etc. from existing NERI cities to Tier 2 and Tier 3 cities including semi-urban and rural areas. The action plan is divided across the following areas: samplification and handholding, funding support and incentives, industry academia partnership and incubation, general studies mains, paper I, cottage industries. This type of industry is run largely by family cravers on full or part-time basis. It has negligible capital investment. These are labor-intensive and use locally available materials. There are various types of cottage industries in Ind that includes silk weaving, cotton weaving, carpet mulung, leather works and metal works. Apart from cheap imports, they also faces competition from medium and large industries which uses high-end technologies for production. Government to provide handholding and technical support had established numerous agencies such as All India Handier and Road and Central Silk Board. Village industries. The industries established in rural area having population below 10,000 and having less than 15,000 as fixed capital investment per worker are termed as village industries. These industries has two major advantage over other industries. Firstly, they are labor intensive, which suits labor surplus country like India. Secondly, there is little requirement of capital. Khadi in Village Industries Commission established in 1957 under Ministry of Micro, Small and Medium Enterprises seeks to plan, promote and facilitate the organization and development of village industries. Index of Industrial Production, IP. The Index of Industrial Production, IP, is an index which shows the growth rates in different industry groups of the economy in a stipulated period of time. The IIP figures are generally seen as important but short-term indicators of performance of industrial activity in a country. The All India IIP is a composite indicator that measures the short-term changes in the volume of production of a basket of industrial products during a given period with respect to that in a chosen base period. It is compiled and published monthly by the Central Statistics Office, CSO, with a time lag of 6 weeks from the reference month. The IIP series in India has been revised from time to time, shifting the industrial sector. 121. Comparison based to a recent period, by reviewing the coverage of items and industries and by improving, as far as practicable, with a view to reflect adequately, the industrial growth and structure. The total weight in the new series of All India IIP has been distributed to mining, manufacturing and electricity sectors on the basis of their share of GDP at factor cost. The maximum weightage and given to manufacturing sector followed by mining. Current base year of IIP is 2011-12 and 8 core industries: coal, crude oil, natural gas, refinery products, fertilizers, steel, cement, electricity, constitute about 40% of IIP. Out of these, maximum weightage is given to petroleum refinery and minimum to fertilizers industry. Industrial sickness. The government defined the industrial sickness for the first time in the Sick Industrial Companies, Special Provisions, Act 1985. According to this act, a medium or large C, non-SSI company was defined as sick if it was registered for at least 7 years, later reduced to 5 years. It incurred cash losses in the current year and the preceding year. Black circle, its entire net worth, paid-up capital and reserves, was eroded. A company is regarded as weak or incipiently sick on the erosion of 50% of its peak net worth during any of preceding 5 financial years. Industrial sickness has been covered in the Companies Second Amendment Act 2002 and Companies Act 2012. According to Companies Second Amendment Act 2002, sick company is defined as one which has accumulated losses in financial year which are equal to 50% or more of its average net worth during 4 years immediately preceding the financial year, or fail to repay its debts within any 3 consecutive quarters on demand made in writing for its repayment by its creditor. Causes of industrial sickness. The causes of industrial sickness can be classified into 2 categories, which are as follows. 1. Internal causes. Internal causes of industrial sickness originate within the unit, so they can be controlled by the unit. These include faults at planning and construction stage, inappropriate plant and machinery, management problems, entrepreneurial problems, deliberate over-exploitation by owners of the UNTI's financial problems, etc. 2. External causes. External causes are supposed to originate outside the unit, so are not under the control of the unit. Such factors include black circle erratic supply of inputs, power cuts, demand and credit constraints, changes in government policies, transport bottlenecks, non-availability of raw materials, labor problems. Sick industrial units have become a prime reason for rise in non-performing assets in Indian banking system. Though 98% of sick units are in small-scale sector. However, these units only account for around 16% of total locked-up bank credit. Rest 84% of the credit is in non-small-scale sector. Revival of sick units. Government has undertaken the following measures to revive the sick industrial units. Industrial Investment Bank of India, IIBI. The government established the Industrial Reconstruction Corporation of India, IRCI, in 1971, as a company registered under the Companies Act. Its objective was to revive and rehabilitate the sick units by providing financial, managerial and technical assistance.
야라워서는 쓴다니까?
122. General Studies, Mains, Paper I. In 1985, IRC was renamed as Industrial Reconstruction Bank of India, RBI, and was converted into a statutory corporation. Further, in 1997, the 1 rupee was transformed into a full-fledged development financial institution and rechristened as Tustole Investment Bank of India B. Board for Industrial and Financial Reconstruction, BIFR. The government set up BIFK in 1987, on the Sick Industrial Companies, Special Provisions, Act ISICA, 1985 was dissolved on the 30th of November 2016. The BIFR was an autobus case judicial body to take final decisions regarding revival and rehabilitation or winding up of the sick MIS. It was mandatory for a sick, weak unit to refer itself to the IFR on receipt of such reference. The board ascertains whether the company is indeed sick. Ill sickness is confined. Use board may allow the company some time to make its net worth positive on its own, prepare revival and rehabilitation package or wind up the unit. National Company Law Tribunal. NCLT. National Company Law Tribunal, NCTT, as a proposed quasi-judicial body which recently got nod from Supreme Court for establishment. NCCT is a significant reform in the framework for resolving corporate insolvency. It has replaced the Company Law Board and the Board for Industrial and Financial Reconstruction, BIR, and be an overreaching body for resolving insolvencies. It will be a main component of the bankruptcy code as well. NCIT could help significantly improve India's ranking in the World Bank's ease of doing business, as it will speed up rehabilitation and winding up of sick companies while evolving an easy exit policy for sick industrial units. Insolvency and Bankruptcy Code, Amendment. Act, 2021. This Amendment Act brings forward the Prepackaged Insolvency Resolution Process, PRP, as a method of tackling enterprises in duress, effectively serving as an alternative to the Corporate Insolvency Resolution Process, CIR. Under the existing CIRP model, an insolvent borrower is taken to bankruptcy court by the creditors for a tune-bound resolution, and the process allows other entities to on for the stressed entity. Under the prepackaged resolution model, the stressed borrower can prepare a resolution plan with the creditors, which could involve selling the company to AR investor before approaching the NCLT. The borrower retains management control of the company until a resolution is decided. The time limit for the resolution has been drastically reduced to 120 days minus 90 days to submit a resolution plan and 30 days or the national company law at BUNA. NCET, approve or reject it. Promoters can also bid for their companies in the case of a BUU. Companies ACT, 2013. The Equal Companies Act, 1956 appeared to be somewhat ineffective at handling some of the present-day challenges. Learning from these experiences, the 2013 Act promises to substantively raise the bar on corporate governance, and in a comprehensive form purpose to deal with relevant themes such as investor protection and fraud mitigation, inclusive agenda, auditor accountability, reporting framework, director responsibility, and efficient restructuring. The 2013 Act is a major step forward and relates to the current economic environment in which companies operate. IR protects the interests of shareholders and removes administrative burden in several areas. The 2013 Act is more outward-looking in attempts to align with international requirements. Features of the Companies Act, 2013. Increased reporting framework. It focuses on mandatory requirement for consolidated financial statement, CFS, gives new definition of subsidiary. Associate, joint venture company, changes depreciation regulation, provides for mandatory internal audit and reporting on internal financial controls. Industrial sector. 123. Higher auditor accountability. The Act and rules notified thereunder describe the terms of appointment and rotation of auditor. It seeks to provide auditor more autonomy as well as seeks to establish accountability. Bill easier restructuring. It simplified procedures for restructuring and advocated rationalizing multi-layered structures. The new Act has introduced a new concept of a fast-track merger. IV, wider director and management responsibility. The Act prescribes for the appointment of a mandatory woman director and puts up additional responsibility on independent directors. Audit Committee is given the task of ensuring controls, sound financial reporting, and overall good corporate governance. Role of the committee includes recommending appointment of auditors and monitoring their independence and performance, approval of related party transactions, scrutiny of intercorporate loans and investments, valuation of undertaking, assets, etc. Emphasis on investor protection. The Companies Act, 2013 has made significant amendments vis-a-vis related party transactions. There are strict consequences in cases of non-compliance. The transactions of a company with its related parties, which are not in the ordinary course of business and which are not arm's length, would require the consent of the board of directors of the company. The concept of class action suits empowered shareholders and depositors to take legal action in case of any fraud by the company or if the affairs of the company are being conducted in a manner prejudicial to the interests of the company or its members or depositors. V. Dormant Company. The 2013 Act states that a company can be classified as dormant when it is formed and registered under this 2013 Act for a future project or to hold an asset or intellectual property and has no significant accounting transaction. V. National Financial Reporting Authority, NFRA. The 2013 Act requires the constitution of NFRA, which has been bestowed with significant powers not only in issuing the authoritative pronouncements, but also in regulating the audit profession. X. Serious Fraud Investigation Office, SFIO. The 2013 Act has bestowed legal status to SFIO. X. Corporate Social Responsibility. The 2013 Act makes an effort to introduce the culture of corporate social responsibility, CSR, in Indian corporates by requiring companies to formulate a corporate social responsibility policy and at least incur a given minimum expenditure on social activities. The Companies Amendment Act, 2015. The Companies Amendment Bill, 2015 got published in Official Gazette of India on the 26th of May 2015 and known as Companies Amendment Act, 2015. 16 key amendment v. Companies Amendment Bill, 2015 are as follows. Omitting requirement for MMIMUM paid-up share capital and consequential changes. The minimum paid-up share capital requirement of 1 Indian rupee, 0.000, in case of a private company, and TNR 5.000, in case of a public company, under Company Act, 2013 has been done away with. According to this act, no minimum paid-up capital requirements will now apply for incorporating private as well as public companies in India. Making common seal optional and consequential changes for authorization for execution of documents. Doing away with the requirement for filing a declaration by a company before commencement of business or exercising its borrowing powers. Prescribing specific punishment for deposits accepted under the new act, to deal with defaults in repayment of depositor. Prohibiting public inspection of board resolutions filed in the registry, including provision for setting off past losses, depreciation before declaring dividend for the year. Streamlining of labor laws by some state governments. Enaction of bankruptcy and insolvency code for easy exit of sick industries. (124) The Companies Amendment Act, 2019. This act was passed with an objective to consolidate and amend various provisions related to the Companies Act, 2013. It tightened the CSR compliance norms and ensured stricter norms for non-compliance of the company law regulations. Companies are now allowed to transfer their unspent CSR funds to a separate account, which must be spent within 3 financial years. Further, the Registrar of Companies is empowered to initiate action for removal of a company's name if it is not carrying. Besides strengthening NFRA, also provides for transfer of function with regard to dealing with applications for change of financial year and shifting of powers for conversion from public to private companies, from National Company Law Tribunal, NCLT, to the central government. Make in India Initiative. Make in India initiative was launched by government simultaneously at national and international level in 2014. The program is aimed at showcasing India as an investment destination. The program is being implemented by the Department of Industrial Policy and Promotion, Ministry of Commerce and Industry. The initiative highlights government's commitment to chart out a new path wherein business entities are extended red carpet welcome in a spirit of active cooperation. The COVID-19 pandemic has resulted in the disruption of trade and investments, especially for sectors such as tourism and manufacturing all across the world. Along with that, the U.S.-China trade war and the COVID-19 crisis has led to global investors looking for other countries such as India, Bangladesh, Thailand and Vietnam for shifting their manufacturing activities. During this pandemic period, Prime Minister of India made a clarion call of making India Atmanirbhar, self-reliant, and vocal for local, for increasing the efficiency of domestic production and consumption processes. General Studies, Mains, paper. Industrial corridors. An industrial corridor is basically a corridor comprising of multimodal transport services that would pass through the states as main artery. It will link main industrial hubs with state-of-the-art infrastructure and seamless logistic facilities. It will promote greenfield investment in creation of high-speed rail network, logistic parks, state-of-art cargo handling facilities and industrial areas. Significance of industrial corridors. It will significantly reduce the logistic cost, which major impediment against competitiveness of India out business activities as per the Companies Act manufacturing sector. These corridors spans in various states of India. Due to huge investment and initiation of both upstream and downstream greenfield industries, huge job opportunities will be created which will be helpful in preventing distress migration. Black circle. It opens window for both private sector and foreign investment in creation of basic infrastructure besides boosting Make in India initiative. Since industries will be scattered in various states, it will save environment from negative externalities caused by concentration of industries. It will facilitate creation of new greenfield cities and township along the corridor, which will raise the standard of human development besides preventing overcrowding of key urban centers. National Industrial Corridor Development and Implementation Trust, NICDIT, supports project development, appraisal, approval and sanction of the project. Till December 2019, 5 industrial corridor has been earmarked for development. 1. Delhi-Mumbai Industrial Corridor. 2. Amritsar-Kolkata Industrial Corridor. 3. Chennai-Bengaluru Industrial Corridor. 4. East Coast Economic Corridor. 5. Bengaluru-Mumbai Industrial Corridor. National Policy on Electronics. The national policy on electronics is formulated by the government to boost India's electronic systems and design manufacturing industry and improve its share in global market. Electronic industry, at about $1.75. Industrial sector. 125. Ilion is one of the largest and fastest growing industries in the world. The demand in Indian market in 2008-09 was $45 billion and is expected to be $400 billion by 2020. National Electronics Policy, 2019. The Union Cabinet has given its approval to the National Policy on Electronics 2019, NPE 2019, proposed by the Ministry of Electronics and Information Technology, MIT. The policy ensures positioning India as a global hub for electronic system design and manufacturing (SDM), by encouraging and driving capabilities in the country for developing core components, including chipsets, and creating an enabling environment for the industry to compare globally. The salient features of NPF 2019 are: create ecosystem for globally competitive ESDM sector promoting domestic manufacturing and export in the entire value chain of ESDM. Provide incentives and support for manufacturing of core electronic components. Provide special package of incentives for mega projects which are extremely high-tech and entail huge investments, such as semiconductor facilities display fabrication. Formulate suitable schemes and incentive mechanisms to encourage new units and expansion of existing units. Promote industry-led R&D and innovation in all subsectors of electronics, including grassroots-level innovations and early-stage startups in emerging technology areas such as 5G, LoT, sensors, artificial intelligence, AI, machine learning, virtual reality, VR, drones, robotics, additive manufacturing, photonics, nano-based devices, etc. Provide incentives and support for significantly enhancing availability of skilled manpower, including reskilling. Special thrust on fabless chip design industry, medical electronic devices industry, automotive electronics industry and power electronics for mobility and strategic electronics industry. Create Sovereign Patent Fund, SPP, to promote the development and acquisition of TPS in ESDM sector. Promote trusted electronics value chain initiatives to improve national cybersecurity profile. The NPE 2019 when implemented will lead to formulation of several schemes, initiatives, projects, etc., in consultation with the CONSMED ministries, departments, for the development of ESDM sector in the country. It will enable flow of investment in technology, leading to higher value addition in the domestically manufactured electronic products, increased electronics hardware manufacturing in the country and their export, while generating substantial employment opportunities. National Mineral Policy, 2019. National Mineral Policy, 2019 replaced the extant National Mineral Policy, 2008, NMP 2008. The impetus to review NMP 2008 came about by way of a direction from the Supreme Court vide its judgment in Common Cause versus Union of India and others. The aim of National Mineral Policy, 2019 is to have a more effective, meaningful and implementable policy that brings in further transparency, better regulation and enforcement, balanced social and economic growth as well as sustainable mining practices. The National Mineral Policy, 2019 includes provisions which will give boost to mining sector. Some of the provisions are: introduction of right of first refusal for RP per PETA holders. Encouraging the private sector to take up exploration. Encouragement of merger and acquisition of minting entities. Greater than creation of dedicated mineral corridors to boost private sector mining areas. The 2019 policy proposes to grant status of industry to mining activity to boost financing of mining for private sector and for acquisitions of mineral assets in other countries by private sector. It also mentions that long-term import-export policy for mineral will help private sector in better planning and stability in business. The policy also mentions rationalized reserved areas given to PSUs which have not been used and to put these areas to auction, which will give more opportunity to private sector for participation. 126. The policy also mentions to make efforts to harmonize taxes, levies and royalty with world benchmarks to help private sector. The policy also introduces the concept of intergenerational equity that deals with the well-being not only of the present generation but also of the generations to come, and also proposes to constitute an interministerial body to institutionalize the mechanism for ensuring sustainable development in mining. Problems of manufacturing sector in India has not been able to develop to its fullest potential. Our manufacturing industry is facing numerous challenges. The most significant challenges are as follows. The failure to develop power and transportation infrastructure commensurate with the needs of the economy. The absence of concerted industrial policy. Various bureaucratic hurdles in getting clearance for setting up an industry. The most important one is corruption. High interest rates cap consumer spending, while slow decision-making by the government in land acquisition issues stalled projects and held back capital expenditure in the sector. Electronics manufacturers have been hit by the Information Technology Agreement with the World Trade Organization. Foreign companies dump their electronic products in India and imports replace domestic production following the agreement signed by India in 1997, which made many electronic products such as notebook computers duty-free. More than half of India's employees in the organized sector, regulated by labor laws for hiring and firing, still work in government-owned institutions, e.g. in the base metals, petroleum and power generation industries. General Studies, Mains, Paper 3. Product market harness and government ownership tend to lower productivity and distort markets significantly. Stringent labor laws make it difficult for Indian companies to restructure and thus, to increase their productivity and expand output. Black Circle GST, environment clearances, cost of money, investment in research and development are the key barriers in improving productivity. The implementation of GST will add approximately 3% growth in the manufacturing sector. Lack of skilled manpower. Need of strong industrial base. India cannot become a developed country without a strong industrial base because the share of agriculture in GDP is 14%, but its share in total employment is 49%. This has led to a high disguised employment in agriculture sector. In India, the services sector has a high share in GDP at 56.9%, but the share of employment is just 28.1%. India, in order to reap the benefits of demographic dividend, the share of manufacturing sector in employment has to increase. India is largely dependent on imports for manufactured goods. This adds to the trade imbalance as well. India, in order to grow sustainably, there is an urgent need to develop the domestic manufacturing sector. A solid industrial base is required for growth of both agriculture and service sector. The demand of services and goods cannot be met for such a huge population until a solid industrial base in country itself.